ODHA account. Chapter 6. Your GBP and JPY. 6.1 The other currency pairs. We focused on the USD-INR pair extensively over the last few chapters. And we now look into the other currency pairs that are traded in the Indian markets. Namely the EUR-INR, GBP-INR, and JPY-INR. The functioning of the other currency pairs is very similar to the USD-INR. Think about it this way: you know how the Nifty 50 contracts work. Then you pretty much know or are capable of knowing how Bank Nifty works. Given this, the agenda for this chapter is to quickly run through the contract specifications of the other three crosses available for us to trade. In the second part of this chapter, we'll dwell on some of the common trading techniques, mainly employing technical analysis. And with this we will conclude our discussion on currencies and start looking into commodities. So let's get started. EUR-INR. Globally, the EUR-USD is one of the most actively traded currencies. However, we do not have that contract yet in India. But RBI has given the exchanges a nod to list these crosses as well. So I guess it is a matter of time before we have the EUR-USD pair along with GBP-USD, JPY-USD, etc. But for now, we do have EUR-INR to trade. The euro, as we know, is the currency of the European Union. Unlike other currencies, the euro is backed by the economy of many European countries and not just one economy. The EUR-INR contract structure is quite similar to the USD-INR contract. Here are the key details that you need to know. Particular EUR-INR remarks. Lot size 1,000 euros in equity derivatives. Lot is number of shares, but here it's in euro amount. Underlying the rate of Indian rupee against 1 euro. Tick size 0.25 peso or in rupee terms INR 0.0025. Trading hours Monday to Friday between 9 a.m. to 5 p.m. Expiry cycle up to 12-month contracts. Note: equity derivatives have an expiry up to 3 months. Last trading day contracts trades till 12:30 p.m. 2 days prior to the last working day, equity derivatives continue to trade till 3:30 p.m. of the expiry day. Final settlement day, last working day of the month. Margin span plus exposure. Usually SAPN is about 1.5%, and exposure is around 1%. Hence roughly about 2.5% is the overall margin requirement. Settlement price RBI reference rate on the day of final settlement, closing price of spot. So as you see, the contract specifications are similar to that of the USD-INR pair. The only difference is that the lot size in EUR-INR is 1,000 euros as opposed to $1,000 in USD-INR. Let's see how this would impact the margins. Here is the snapshot of the EUR-INR futures. As you can see, the last traded price of the contract is 74.8950. With this we can estimate the contract value. Contract value equals lot size asterisk contract price equals 1,000 asterisk 74.8950 equals 74,895.0. Assuming the margin is approximately 2.5%, the margin should be in the vicinity of 1,870 rupees per. In fact, one can use the margin calculator on Zerodha to get the exact value of the margin required. So the margins are slightly higher than the USD-INR pair, but still way lower compared to what is required for any equity derivative contract. GBP-INR. The GBP-INR contract is probably the second most popular currency contract after the USD-INR pair. On the contract specification side of things, everything remains the same except for the lot size and the underlying. The underlying is the exchange rate of £1 in Indian rupees. The lot size is £1,000, which makes the contract value approximately 89,345 rupees per, considering the futures is trading at 89.3450 as of the 5th of August 2016. As you see below, the margin required for this slightly higher compared to the other two contracts we've already discussed. By the way, did you know in the international markets that the GBP-USD pair is also called the cable? So, when you hear a currency trader say he is short cable, He means he is short GBP USD cross JPY-INR. The JPY-INR contracts are a bit tricky compared to the other currency contracts. The lot size is not the usual 1,000 units, but 100,000, and the underlying here is the exchange rate for 100 Japanese yen and Indian rupees. So when we look at this, we are essentially looking at the rate of 100 Japanese yen, stated in Indian rupees. In other words, it costs 66 rupees .2750 to buy 100 Japanese yen. Since the lot size is 100,000, the contract value is equals 100,000 asterisk 66.2750 100 equals 66,275 rupees per. The margin required for the JPY-INR contract is 2,808 rupees per, which translates to about 4.2%. Clearly, the margins required for JPY-INR contract is the highest in the currency segment. And I guess this is because this contract could be the most volatile owing to lower liquidity. Of course, this is just a casual observation. I'd encourage you to calculate the actual value on Excel to get a perspective on volatility of JPY-INR. Spread contracts are available on all the currency pairs across all the expiries. Here is the snapshot of the same form on SE's website. But as you can see, the spread contracts, apart from USD-INR, are not really liquid. Finally, if you were to select contracts to trade based on liquidity, here's what I'd suggest you look at. In order of preference: USD-INR futures, USD-INR ATM options, GBP-INR futures, EUR-INR futures, JPY-INR futures. With this, I'm assuming that you are clear with the logistics involved in currency trading. We now focus on developing some basic trading approach. 6.2 The test for seasonality. There is often a lot of debate on the seasonality involved in currencies. By seasonality, I mean things like USD-INR always goes down in December, or something like USD-INR always goes up a week before expiry. In fact, many people base their trades based on this expectation without actually validating for seasonality. Given this, we thought we should check for the seasonality in currencies. And needless to say, we picked the USD-INR spot data to run the required test. Asterisk, asterisk, warning, asterisk, asterisk. The following discussion can get a bit technical, and this is not meant for regular varsity readers. If you want a direct answer for whether any sort of seasonality exists in the USD-INR pair, then the straightforward answer is no. There is seasonality of any sort across any time frame. With this conclusion, you can jump directly to the next section. However, if you have a statistical approach to things, then you may just want to read through. Of course, I'll try my best to keep it brief. Also, this section is contributed by our good friend Prakash. Any queries regarding this should be directed to prakashlekala@gmail.com. Seasonality in any time series can be checked by employing a statistical test called Holt-Winters test. A typical Holt-Winters method has three components: level, trend, seasonality. Level. This indicator measures the average change in USD-INR on a YOY basis. Trend. This indicator measures the average change in USD-INR on a month-on-month basis. Seasonality. This indicator measures if there is any seasonal impact on price change. For example, USD-INR almost always rises in January, and almost always falls in April, etc. There are two possibilities for components: level, trend, and seasonality. Additive, multiplicative. I guess the details of this are beyond the scope of this discussion. Holt-Winters test for seasonality. In Holt-Winters test, we check for seasonality in a time series by building a forecast model, let us call it Model 1, and study its residuals. Model 1 does not have any seasonality component inbuilt. We then build another forecast model with a seasonality component, Model 2, and check for the errors of this model. We compare the errors of both the models and compare to check if Model 2 gives us a better forecast when compared to Model 1. We do this by employing chi-square test to determine if accuracies are better. If Model 2 is statistically better than Model 1, then we conclude that there is some seasonal pattern in data. However, if the accuracies are same for both models, or if Model 1 has better accuracy, there is no seasonality in data. Seasonality results for USD-INR. Check for weekly seasonality. Model 1 without seasonality component. The best model is M. N with coefficients 0.9999. This model indicates that weekly data has only level component and no trend component. The coefficient of level is 0.9999, i.e. next week's price is about 0.9999 times this week's price. For readers who are aware of random walk theory will be able to appreciate these parameters. The model is suggesting that on a weekly basis USD-INR price movement is a random walk. Model 2 with seasonality component, the best model is M with coefficients 0.7 and 0.0786. This model indicates that weekly data has level and seasonality component. The interpretation is that next week's price is 0.7 times of this week's price, and the remaining price is contributed by seasonality. Conclusion. Chi-square test concluded that there is 100% chance that Model 2 accuracy is same as Model 1 accuracy, i.e. forcing a seasonality model on USD-INR isn't increasing its accuracy. This can only happen when there is no seasonality in the data. As the data is prepared for weekly analysis, we can conclude that there is no seasonality on weekly basis. Monthly seasonality. Model 1. The best model is N with coefficients 0.9999. Like in the case of a weekly model on monthly data also suggests a random walk. Model 2. The best model is N with coefficients 0.9999 and 0.0001. This model indicates that next month closing price is almost same as this month's closing price, with a small impact of seasonality. Conclusion. Chi-square test concluded that there is a 20% chance that Model 2 accuracy is better than Model 1 accuracy. In statistical terms, such improvement in accuracy may happen due to randomness, like the window period you choose, the sample data, etc. Typically in statistics, the norm is to look for at least 95% chance that Model 2's accuracy is better than Model 1's to conclude there is seasonality in data. So in case of USD-INR, we can conclude that there is neither monthly nor weekly seasonality. The last 8 years USD-INR spot data for this is taken from RBI's website. So the next time you hear someone make a random statement like the USD-INR pair almost always goes down before Christmas, then you know he is just trying to sound smart with no real insights. Smiley face. 6.3 Classic Ta. Thinking about conducting a fundamental analysis on a company. For example, Hindustan Unilever Limited. Typically, you would study its business, financial statements, corporate governance, study its peers, and perhaps build a financial model to identify if the stock is worth investing in. Fundamental analysis is kind of a straightforward affair when it comes to equities. However, when you look at currency pairs, USD-INR for example, there are a lot more fundamental dimensions, the macroeconomics of the USA, which is dependent on multiple domestic and international factors, and the macroeconomics of India, which is again dependent on multiple domestic and international factors. Once you understand these, you need weigh each one of these against another and build a relative view. Frankly speaking, this is no easy task, and not many are capable of doing this. You need to be an economist with a trader's mindset to pull off quality fundamental analysis on currency pairs. Perhaps this is the reason why technical analysis (TA) is so much more popular when it comes to trading currencies and commodities. As you probably aware, technical analysis assumes that the price that you see on the screen discounts everything, including all the complex fundamental views that are panning out at the moment. With this assumption, you go ahead and analyze the charts and develop a viewpoint. Ta on currencies and commodities works just like it does on equities. If you are not conversant on how to use technical analysis, I'd strongly suggest you read through this module on Ta. I'll post few snapshots of Ta-based trade setups. The two encircled candles form a classic candlestick pattern called piercing pattern. The piercing pattern suggests the trader to go long on the USD-INR pair. As you can see, the trade panned out well without triggering the stop loss. Here is a bearish Marubozu on GBP-INR. The bearish Marubozu suggests you to short the underlying with an expectation that the asset will continue to slide down. Naturally, the trade setups can be endless. I know many people are under the belief that currency and commodities requires one to know a different set of technical analysis. But this is not true. Ta works exactly the same way on any time series data. Be it stocks, commodities, currencies, or bonds. And with this, I would like to end our discussion on currencies and would like to start our discussion on the second part of this module, i.e. commodity trading. Key takeaways from the chapter. The underlying for your INR is the spot rate of €1 in Indian rupees. The lot size for your INR is euro. The underlying for GBP INR is the spot rate of £1 British pound in Indian rupees. GBP INR is the second most traded contract in the currency segment. The lot size for GBP INR is pound. Internationally, GBP USD is also referred to as the cable. JPY INR has the highest margin requirement in the currency segment. Perhaps due to the higher volatility, lot size in JPY INR is 100,000. The underlying in JPY INR is the rate of 100 Japanese yen in Indian rupees. As opposed to popular belief, there is no seasonality in the USD INR pair, either on the weekly basis or on a monthly basis. Ta can be applied to currencies just like the way it can be applied to stocks. Open a ZERODHA account. Chapter 7. Gold, Part 1. 7.1 Orientation. As you know, there are two commodity exchanges in India, Multi-Commodity Exchange (MCX) and National Commodity and Derivative Exchange (NCDEX). MCX is particularly popular for the metals and energy commodities, while NCDEX for all the agri-commodities. However, there is a lot of activity picking up on MCX for agri-commodities as well. My job over the next few chapters is to discuss these commodities which are traded on the exchanges and get you familiar with the commodity contracts. We will look into each and every commodity that is actively traded on the commodity exchanges. The idea is to know how the commodity contract works, contract specification, figure out which contract to trade, and identify the factor which influences the commodity. I will skip the usual background to commodities market part, the one which talks about the history, forwards markets, the farmers in US, the Chicago Mercantile Exchange, etc. You will find this in almost any material on commodity market. I would like to get straight to the heart of the topic by slicing and dicing the contract, specifications of commodities and other details around them. Here is the list of commodities available on MCX to trade. Of course, I got this list from the MCX website. The idea is to cover all the major commodities that one can trade. Needless to say, one has to know how derivative futures function before attempting to understand commodities. So if you are not familiar with futures, I'd encourage you to read the module on futures trading. Anyway, assuming you are familiar with futures, we will now start with gold. 7.2 The gold contract. Gold is a very actively traded contract in MCX. It has ample liquidity, with daily trades of roughly 15,000 contracts translating to a rupee value of over 4,500 crore. Note, these numbers belong to just one type of gold contract, often nicknamed big gold. Gold comes in quite a few variants that one can choose to trade in. Newbie and sometimes even the experienced commodity traders often get confused with these contracts, not knowing which one to trade and the difference between them. To begin with, let me list down all the different types of gold contracts. Gold, the big gold. Gold mini. Gold Guinea. Gold Petal. All these variants belong to the same underlying, i.e. gold. I guess the best way to understand the difference is by understanding the contract specification of each of these variants. We will start with the big boy first, i.e. the gold. Here is the contract specification as per MCX. Let me list the important things first and then we will understand them one by one. Particular value. Price quotation rupee per 10 grams inclusive of all taxes and levies relating to import duty. Lot size 1 kilogram. Tick size 1 rupee. P&L per tick Rs. 100. Expiry date 5th day of contract month. Delivery logic compulsory. Delivery unit 1 kilogram. Let me discuss these details in the same sequential order, so that it becomes easy for you to understand the subsequent contracts. We'll start with the price quotation. The price quotation, as you can see, is for 10 grams of gold. This price includes all the import duties and taxes. Of course, we will talk more about this at a later stage. For now, just be aware that the price on MCX is all inclusive. Have a look at the following snapshot. It shows the last traded price of gold futures on MCX. As you can see, the last traded price of gold is 31,331 rupees per denote. This is the quote for 10 grams of gold. Since the lot size is 1 kilogram, 1,000 grams, we can calculate the contract value. 1,000 asterisk 31,331.10 equals 31 rupees, 33,100. So what is the margin required to trade this? We can check this from Zeroda's margin calculator. The margin amount required is 1 rupee, 25,868, which means the margin percentage is roughly 1, 25,868 31st, 33,100 equals 4.017%. As you can see, the margin percentage is just about 4%, which is pretty much similar to the currency contracts. However, the rupee value of the margin is way too high and it therefore prohibits many retail traders to initiate positions in gold. In fact, this is the reason we have contracts like Gold Mini and Gold Petal, where the rupee value of the margins is lower. We will talk about these contracts a little later. Now assume you buy one lot of gold on MCX. This means you have to par close to 1.25 lakhs as margin, and with each tick you will either make 100 rupees or lose 100 rupees. And how did we arrive at that? Well, it is fairly simple. P&L per tick equals lot size, quotation, asterisk tick size. Let us apply this on gold. Equals 1,000 grams, 10 grams, asterisk 1 rupee. Equals 100 rupees. In fact, you can apply this formula to any futures and options contract to calculate the P&L per tick. Let me demonstrate this formula for the JPY-INR contract. If you recollect, the lot size for this contract is 100,000 Japanese yen, and the quotation was for 100 Japanese yen, and the tick size is 0.0025. Using this, we can calculate the P&L per tick. 100,000 100s asterisk 0.0025 equals 2.5 rupees. Anyway, let us now focus on the expiry. If you look at the expiry of gold, it simply says 5th day of contract month. Gold contracts are introduced every 2 months and each contract stays in the system for a year. And at any point you will have 6 contracts to choose from. Considering we are in August 2016, the following table should give you an idea of how this works. Current available contract expires on October 2016 5th, October 2016, December 2016 5th, December 2016, February 2017 5th, February 2017, April 2017 5th, April 2017, June 2017 5th, June 2017. August 2017, 5th August 2017. Needless to say, the most recent contract is the most liquid contract to trade. In this case it would be October 2016 contract. Now, when the October 2016 contract expires on the 5th of October 2016, September 2017 contract will be introduced. And the most active contract from the 5th of October 2016 would now be the December 2016 contract. Do recall, settlement in equities is always in cash and not physical. However, when it comes to commodities, the settlement is physical and therefore delivery is compulsorily. This means if you hold 10 lots of gold and you opt for delivery, then you will get 10 kilograms of gold. In order to get the delivery of the commodity, one has to express his intention to do so. This has to be done any time before 4 days to expiry. So given that the expiry is on 5th, one has to express his intent to take delivery any time on or before the 4th, 1st, 2nd, 3rd, 4th. If you are trading with 0 to then do note, we do not allow you to get into the physical delivery of commodities. So you will be forced to close the position before 1st of the expiry month. In fact, I personally prefer to close the positions early on and not really get into the physical delivery of commodities. For all practical purposes, if you know these things about the gold contract, you pretty much know what is really required before you trade the big gold contract. We will now move on to note the other variants of gold that gets traded on the exchange. 7.3 The other contracts: Gold Mini, Gold Guinea, Gold Petal. The big gold contract, as you realize, demands a heavy margin requirement in terms of rupee value. This prevents a lot of traders from trading the big gold contract, and perhaps this is the reason the exchanges introduced contracts with much lesser margin requirement. The other gold contracts that are available to trade is Gold Mini, Gold Guinea, Gold Petal. The details for the other gold contracts are as follows. Price quote, lot size, tick size, P&L, tick expiry, delivery logic, delivery unit. Gold Mini Rs. Per 10 GM 100 GM 1 rupee 10 rupees 5th day compulsory 100 GM. Gold Guinea Rs. Per 8 GM 8 GM 1 rupee last day compulsory 8 GM. Gold Petal Rs. Per 1 GM 1 GM 1 rupee last day compulsory 8 GM. I'm assuming the table above is a lot easier to understand now, considering we have discussed these details earlier. Let's dig straight into the margin details. As you can see, Gold Mini Goldum contract requires a margin of 15,682 rupees per. In terms of percentage, equals margin, contract value. Contract value equals price asterisk lot size price quotation equals 31,365 asterisk 110 equals 313,650 rupees equals 15,682 313,650ths equals 5%. In terms of margin percentage, this is roughly the same as big gold. For the sake of completeness, let us quickly calculate the P&L per tick for Gold Mini. We know P&L per tick equals lot size quotation asterisk tick size equals 110 asterisk 1 equals 10 rupees per tick. Beyond the Gold Mini contract, we have Gold Guinea and Gold Petal contract. These are extremely tiny contracts which demand a very low margin, as low as 1,251 rupees Gold Guinea and 154 rupees Gold Petal. The lot size is small and therefore the contract value is small as well. You will find few variants like Gold Petal, Delhi, Gold Guinea, Ahmedabad, etc. I would suggest you ignore these, especially if your idea is to just trade gold. Here is my honest opinion: if you are trading gold, stick to either the big gold contract or the Gold Mini contract, simply because the liquidity is quite bad in all the other contracts. To give you a perspective on liquidity on a regular trading day on MCX, 12-13K lots of big gold contracts get traded. 14 to 15K lots of Gold Mini contracts get traded. 1 to 1.5k lots of gold Guinea contracts get traded. 8 to 9k lots of gold Petal contracts get traded. The number of lots in gold Petal should not entice you to believe that the liquidity is high. Do remember gold Petal lot size is just 8 grams. And therefore 8 to 9k lots translates to roughly 2 to 2.5 CRS. Another important thing to note, liquidity is highest in the most nearest month contract. So always stick to these. The thumb rule here is farther the contract expiry, lower is the liquidity. With this, I assume you are familiar with the gold contracts and the logistics. In the next chapter we will discuss few interesting topics such as the parity in domestic and international gold contracts, factors influencing gold, relationship between gold, equities, and dollar, etc. Key takeaways from this chapter. Gold is one of the most popular bullion contracts that gets traded on MCX. Gold contract comes in a few variants: Big Gold, Gold Mini, Gold Guinea, and Gold Petal. Big Gold is the most popular contract, but requires a margin in excess of 1 rupee, 25,000. The P&L per tick for the Big Gold is 100 rupees. P&L per tick can be calculated as equals lot size, quotation, asterisk tick size. Gold Mini is the second most popular gold contract. Requires a margin of roughly 15k. Gold Petal and Guinea are other variants demanding much lower margin requirement. However, the liquidity in these contracts is quite low. It is always a good idea to stick to the nearest month contract as liquidity is high in these contracts. Delivery is compulsory for all these contracts. Therefore, it makes sense to close these contracts at least 4 days before the expiry of the contract. Open a ZERODHA account. Chapter 8. Gold, Part 2. 8.1 The London Fix. In the previous chapter we discussed the various gold contracts that are available on MCX. I'd like to begin this chapter by discussing how the prices of gold in the spot market are arrived at internationally and in India. However, I have to mention this method to fix gold prices is merely symbolic and holds very little relevance to trading gold futures at MCX. I'm discussing this simply because it is an interesting thing to know. Internationally, the price of gold is fixed in London on a daily basis, twice a day in 2 different sessions. The morning session at 10:30 a.m. is referred to as AM fix, and the evening session at 3 p.m. is called the PM fix. The prices are fixed by the gold dealers from London's biggest bullion desk. The whole process is facilitated by Nathan Mayer Rothschild and Sons. There are about 10 to 11 participating banks, which include names like JP Morgan, Standard Chartered, Scotia Makata, Scotiabank, Societe Generale, etc. Do note, the general public and other banks are not permitted to participate in this process. The dealers from these banks call the dedicated conference line at the designated time and submit their bids to buy and sell gold. From all the bids and offers, an average price is arrived at, and the same price is relayed to the market, which then becomes the benchmark for gold trading. The whole process lasts for about 10 to 15 minutes. The process is again repeated in the PM session, and the gold prices are again discovered and relayed to the markets. The gold price that is fixed by the AM and PM sessions is very close to the actual price of gold that is traded in London and other international markets. So in a sense, the price that is relayed holds no surprise to traders or bullion dealers. In fact, some participants even believe that, like many things in England, even this is conducted more to keep up with tradition. India too follows a somewhat similar practice, but less elaborate. India, being one of the biggest consumers of gold, imports the yellow metal. The gold is imported by designated banks, and the banks in turn supply this gold to bullion dealers after adding the necessary charges. More on this a little later. The Indian Bullion Association then bids for the gold through its network of bullion dealers. These dealers mainly base their quotes on how much gold they would like to buy or sell at a given price. The rates are averaged out, and this roughly sets the floor for the gold prices in India. In fact, there is some sort of circularity here because dealers tend to look at the gold futures price traded on MCX before placing their bids with the Indian Bullion Association. Anyway, this price is relayed to the dealers and jewelers network and the price for the day is set. 8.2 Gold Price Disparity. Traders tend to compare the gold futures rate in Chicago Mercantile Exchange CME and the gold futures rate on MCX and assume there is an arbitrage opportunity lurking around. The rationale for this is that gold, being an international commodity, should often trade at around the same price, in the absence of which an arbitrage opportunity arises. So for example, if 10 grams of 995 purity gold in CME is quoted at $430, then on MCX the price of 10 grams of 995 purity should be in and around $430. But this is often not the case. They trade at a significantly different price, and due to this, a disparity between gold futures in CME and MCX always exists. The question, however, is, why does this disparity between the two gold future contracts exist? Let us figure this out. To understand the disparity between the two future contracts, one should understand how the gold spot rate evolves in India. Remember, India is a net importer of gold. In the international markets, US especially, gold is quoted on a per troy ounce basis. 1 troy ounce is approximately 31.1035 grams. Assume gold in the US spot market is traded at $1,320 per troy ounce. Given this, what do you think should be the spot price of gold in India? Assume $1 equals 65 rupees. The general tendency is to identify the cost for 10 gram of gold in USD and multiply the same with the current USD INR rate and figure out the price. Let us do this math quickly. 31.1 grams equals $1,320. Therefore 10 grams equals $424.43. Since USD INR is at 65, the price of gold in India should be approximately equals 27,588 rupees per. Unfortunately, in reality this is not so straightforward. Gold, when imported, remember it is the banks which import gold, attracts duties and taxes. The spot price of gold in India should include all these charges. In fact, let me list down all the costs that are applicable when a bank imports gold. CIF applicable in dollars. CIF stands for cost, insurance, and freight. Custom duty, cess, bank cost. With all these charges, the landed price of gold tends to increase. In fact, this post on Trading Today beautifully illustrates how the cost adds up. So for example, if the rate of spot gold in US is $420 per 10 grams, then in India, after adding all the additional costs, the spot rate will be much higher. For the sake of this discussion, let us assume the rate in India is $435, leading to a $15 disparity in spot rates. Now, this explains the disparity in spot rates. But what about the futures price? Remember, the futures prices is derived from spot rates. The formula linking futures price with spot price is F equals S asterisk E RT. You can read more on futures pricing. So in the US markets, the basis for the future pricing will be the spot price of gold in the US, i.e., $420. While at the same time the basis for the future price in India will be the spot price of gold in India, i.e., $435. Given this, naturally the futures price of gold in CME and MCX will differ. This difference should not be mistaken for an arbitrage opportunity. 8.3 What drives the gold price? Investors across the world have this strange but predictable behavior at times of uncertainties. Well, at least economic uncertainties. They are all in a hurry to buy gold. Gold has always been considered a safe haven capable of safeguarding investments against any sort of economic meltdown. Consider the Brexit June 2016 event, the most recent event which kind of shook the world. And here is how gold behaved before and after the event. There was a clear run-up in gold before the event and post the event. In fact, the big candle that you see during this period is on the 24th of June, the day after the Brexit verdict was out. Naturally, gold rallied owing to the outcome of Brexit. In fact, each and every time there is any sort of global domestic uncertainty, investors flock to buy gold. This is mainly driven by the fact that gold is considered a safe haven, capable of preserving your wealth. Almost all the major events in the past has had an impact on gold. Think about it: oil crisis, Middle Eastern uprising, Israel-Palestine, EU migrant crisis, Greek economy, Euro crisis, Lehman Brothers. The list is never ending. But the point to note is that every world event impacts the prices of gold. This leads us to an important conclusion: gold tends to increase in value in the backdrop of economic uncertainties. In fact, in the backdrop of economic uncertainties, demand for risky assets such as equities goes down, and the demand for safe haven assets such as gold tends to increase. Now, besides the uncertain events, even on a day-to-day basis, investors tend to buy gold considering it a safe hedge against inflation. They believe, in the long run, the value of gold will continue to rise. This perception is justified if you look at a very long-term chart of gold. Source: http://www.lbma.org.uk/pricing-and-statistics. Take a look at the chart above. In 1970, gold was at roughly $35, and today in 2016, gold is at $1,360, translating to a 37x return. However, when you look at it from a CARG perspective, this translates to about 8% year-on-year growth. The world average inflation is roughly between 5 to 6%. This means if you are an investor in gold, on one hand you are expected to make 8% and on the other you lose about 6% owing to inflation, netting you with an outperformance of 2%. However, in countries such as India where inflation is high, investment in gold does not really fetch much. 8.4 gold, dollar, rupee, and interest rates. The movement in gold is also related to how the currencies and interest rate of the economy moves. So if you are a trader in gold, then it is not only important to keep track of world economics, but also important to keep track of currencies and interest rates. The equations are simple. Let us start with the dollar and build on it. Have a look at this graph below. Source: https://fred.stlouisfed.org/graph/g=33 This is the graph of USD versus gold. The inverse relation between the two is quite evident. This inverse relation can broadly attributed to two reasons. When the dollar decreases in values with respect to another currency, then the value of the other currency increases. With the increase in the currency value, the demand for commodities including gold tends to increase. As the demand for gold increases, the prices too tend to increase. A falling US dollar becomes less attractive to investors. The investors tend to look at parking their money in safer havens such as gold. Having said this, one should be aware that this may not always be true. There could be instances when both gold and USD tends to increase. For example, think about a crisis in Saudi Arabia, declining oil prices. Domestic investors may want to move away from investments in Saudi and park it in safer assets such as gold and USD, thereby increasing the value of both these assets. Either ways, it must be clear to you now that USD has a role to play in the directional movement of gold. Having said, one must study the correlations between various variables and gold to see if any correlations actually exist. For example, increase in the US federal rates tends to strengthen the US dollar. By virtue of this, gold price should reduce. But this does not necessarily happen all the time. And if I'm right, the correlation between gold and federal rates is just under 0.3. I understand the discussion above is kind of counterintuitive. As in earlier I mentioned, a strong dollar tends to push gold prices down. But the factors that influence USD may not actually have a strong bearing on gold itself. Confusing. Yes, it is. I agree. So how would one actually trade gold? One of the best ways to trade gold is by studying its demand and supply. Demand and supply factors are many and complex, especially for an international commodity such as gold. However, the demand and supply pressures reflect themselves in prices and in a sense manifest themselves in the form of charts. And charts can be read by means of technical analysis. And this is how you can develop trading insights in gold. I'm a huge fan of fundamental analysis when it comes to equities. But when it comes to commodities and currencies, I resort to charts. 8.5 Technical Analysis on Gold. If you are not familiar with technical analysis, TA, then I'd suggest you read the module on TA. One of the key attributes of TA is that TA can be applied to any asset class including currencies and commodities. Let me develop some trading notes on gold by employing TA. Hopefully this will give you a sense of how to apply TA on gold. When I trade gold, the objective is very clear. It is a short-term trade and there are no intentions to carry the trade for say more than few days. The very first thing that I do when developing a trading view is to look at the long-term chart of the asset. By long-term I mean at least 2 years. I'll do the same here. I'll look at the end-of-day gold B's ETF chart for this. To note, I will use this chart to develop a rough idea on the primary trend of gold and also observe critical price points, if any. From the chart above, I note the following points. Gold declined starting from late 2013, all the way to late 2015. Prices kind of bottomed over the last few months of 2015. Gold in fact formed a double bottom between Sept to December 2015. Prices have been trending up since early 2016. Traders have bought gold at every decline starting from early 2016. Clearly the bearishness in gold is no longer there. This is evident given the fact that gold has scaled back to 2013 prices. With all this, I can conclude that I'd be more comfortable with long trades than short. But this does not mean that I will not short gold. I would, if the risk to reward is enticing enough. However, if I short gold, I will always be aware that traders out there are looking for opportunities to buy gold at every dip. Hence I will be quick to cover my short position. To note, until this stage 1 have only developed a broad-based view on gold and have not ventured into any specific price levels. I would now be interested in looking at a short-term chart of gold to identify trading opportunities if any. Have a look at the chart below. Before we get into identifying trading opportunities, for which we will have to look at the right side of the chart, let's spend a little time on the left side of the chart. The starting point of this chart is sometime in the late 2015 until about end of June 2016. There is pretty much no activity. This is evident when you look at both the price and volume. The volume is almost non-existent, and the prices just tend to gap up and down. Can you guess why? Well, remember gold contracts are introduced almost a year in advance. For example, the October 2016 contract, which we are looking at, would have been introduced around October 2015. However, this contract does not attract any liquidity till it nears its actual expiry, i.e., October 2016. If, on the other hand, our markets were very vibrant with lots of liquidity, then probably this contract would have attracted liquidity much earlier. Anyway, let us now look into the left side of the chart and identify trading opportunities if any. I'll repost the chart emphasizing the recent candles. I have overlaid 9 and 21-day exponential moving averages on the prices. The current market price is below both the short-term averages. There are 3 price action zones in the recent past at around 30,956. I've encircled the same in blue circles. And since the current market price is below this level, 30,956 becomes an immediate resistance. In the recent past, we can see a bearish Marubozu formed circled in black, which has played out well. Traders may be booking profits on this one. Considering all the above, I would be looking at buying opportunities in gold the moment it crosses the resistance level of 30,956. Notice, this also coincides with the two short-term moving averages, which further encourages me to go long. However, if the price of gold stays below the resistance level, I would hesitate to short for reasons we discussed earlier. So in summary, my trade would be something like this. Position: long. Price: above 30,956. Target: 31,418. Have placed a short blue line. Stop loss: 30,700. Current market price. Reward to risk assuming I'm going long at 30,956. 1.8% move from entry. 1.5%. Not a bad trade from a reward to risk perspective, I'd think. Also, since we are looking a 1.5% move, this may pretty much happen in a single day. Anyway, the whole point here is to elaborately explain to you that ta can easily be applied to commodities, such as gold. I hope the last two chapters have given you enough information on gold. This, according to me, has put you in a good spot to get started in trading gold. Onwards to silver. Key takeaways from this chapter. The price of gold if fixed twice a day in the AM and PM session in London. Only designated banks can participate in the London fix. India too has a gold fix, similar to London fix. However, there is some sort of circularity here as traders tend to look at the prices of MCX. Spot price of gold in US and India differs mainly owing to the additions, duties, taxes, and charges that get added in India. Since spot prices vary, so does futures price. Dollar and gold are inversely related. Commodity fundamentals are complex to understand. Hence, traders tend to look at demand and supply. Demand and supply reflects in the current price, and also manifests itself in charts. You can apply technical analysis on gold and other commodities. Open a ZERODHA account. Chapter 9. Silver. 9.1 The Bullion Twins. To begin with, I need to apologize for the delay in putting up this chapter. Perhaps this is the longest in-between chapter break I've taken from the time I have started writing for Varsity. I've been working on another high-priority project which required my time and attention. Hence the delay. Anyway, let us get straight to work and discuss silver. Precious metals such as gold, silver, and platinum are collectively referred to as bullion. There is a common perception that the market price of gold and silver makes similar moves. If this is true, then it gives rise to many trading opportunities such as pair trading. We will discuss pair trading in detail, perhaps in a different module altogether. However, let us go ahead and investigate if gold and silver move in tandem. I did run a correlation check on gold and silver using 30 minutes intraday data for the last 3 months. Note this is over 1,000 data points, and here are the results. The correlation on an intraday basis is 0.7, which is quite remarkable. I'm guessing the correlation on end-of-day basis would be even better. So what does this mean? Well, the correlation suggests that the two metals make similar moves on an intraday basis. If you recall, we discussed the concept of correlation in detail in the USD/INR chapter. I'd suggest you read up section 5.3 of chapter 5 if you haven't already done so. If the intraday correlation is as tight as 0.7, then we can think about exploring trading ideas of going long on gold and short on silver or vice versa. This will be a kind of hedged strategy as you are long and short on similar assets at the same time. The idea here is just to let you know that building such a trading strategy is a possibility. Please don't jump in and set up a trade just with this information. J. There are lots of other things to take care of when you initiate such trades. More on pair trading at a later point. Meanwhile, have a look at the intraday graph of both gold and silver. I've normalized it to start at 100 so that the graphs are more comparable. If you were to just look at the graph and take a call on how closely the two metals move, then chances are you would disregard any sort of correlation between them, J. But the actual numbers paints a completely different picture. Anyway, as I mentioned earlier, I've used intraday data here to develop both the correlation and the graph. Longer-term data will portray more meaningful information. In fact, I dug up the correlation data between silver and gold from a recent survey by Thomson Reuters. And here is what they suggest. The correlations are broken down on a quarterly basis, clearly a longer-term approach here, and as you can see, the correlation between gold and silver is on average is about 0.8, which is why traders prefer to call this pair the Bullion Twins. The tight EOD correlation implies that traders and investors consider both gold and silver as safe havens in times of economic crisis. This further implies that any global geopolitical tensions tend to drive the price of not just gold, but silver as well. Also, please do note the correlation of silver with oil. It is quite erratic and gives a sense on unreliability here. 9.2 The Silver Basics. Silver has applications in industrial fabrication, photography, fashion, electrical, and electronics industries. Hence, there is always a demand for silver. In fact, the recent survey from the Silver Institute in the United States suggests that the global silver demand stands at 1,170.5 million ounces. Historically, the demand for silver has grown at roughly 2.5% year-on-year. Out of the total global demand, bulk of it comes from industrial fabrication and manufacturing. This directly suggests that the price of silver is kind of influenced by growth of manufacturing and industrial economies such as China and, to some extent, India. On the supply side, global mining production along with scarp and sovereign sales stands at 1,040.6 million ounces, clearly indicating that silver as a commodity is under slight deficit. The supply has not really improved over the years. In fact, the data suggests that the growth in supply has just been about 1.4%. Here is the table which gives you the complete demand-supply scenario in silver. You can read the complete survey report. Given how the supply and demand scenario plays out, there is a lot of scope to trade silver as a commodity. This leads us back to the most important question: who decides the rate of silver? Well, silver rates are fixed the same way as that of gold. In London, by a pool of participating banks. To know how gold-silver rates are fixed, I'd recommend you read this. 9.3 The Silver Contracts. There are 4 variants of silver contracts that are available for you to trade on MCX. They differ mainly in terms of contract value, and therefore the margin required. These contracts are as follows. Contracts price quote lot size tick size P&L tick expiry delivery units. Silver 1 kg 30 kgs 1 rupee per tick 30 rupees per tick 5th day of expiry month 30 kgs. Silver mini 1 kg 5 kgs 1 rupee per tick 5 rupees per tick last day of expiry month 30 kgs. Silver micro 1 kg 1 kg 1 rupee per tick 1 rupee per tick last day of expiry month 30 kgs. Silver 1000 1 kg 1 kg 1 rupee per tick 1 rupee per tick last day of expiry month 1 kg. Of all the 4 contracts, the Silver 30 kg contract and Silver Mini are most actively traded on MCX. We shall discuss both these contracts detail. Let us begin with the main silver contract. The price quotation for the silver contract is 1 kg. This means when you check the price of silver on MCX or on your trading terminal, the price that you see is for 1 kg of silver. This price includes the import duties, taxes, and all the other applicable duties. Have a look at the screenshot below taken from Kite. The current price of silver December future is 42,266 rupees per. Note this is quoted on a per kilogram basis. Since the contract is for 30 kgs lot size, the contract value will be equals 30 asterisk 42,266 equals 12 rupees 67,980. The margins on silver is roughly 5%. In fact, here is the snapshot of the margin required to trade this contract. This works out to equals 68,619 1,267,980 equals 5.41%. The P&L per tick can be calculated using the following formula. P&L per tick equals lot size, quotation, asterisk tick size, equals 30 kgs, 1 kilogram, asterisk 1 rupee per, equals Rs. 30. So for every tick on silver, you either make 30 rupees per or lose 30 rupees per. As far as the contract's expiries are concerned, here are the set of contracts that are available to trade as of now, as of October 2016. Note all contracts expire on the 5th of the contract month. December 2016, March 2017, May 2017, July 2017, September 2017. When the December 2016 contract expires, the December 2017 contract gets introduced to the market. You must be aware by now that the most liquid contract to trade would be the one which has the closest expiry date. For example, we are now in October 2016 and if I were to trade silver, I'd choose the December 2016 contract. Do recall, settlement in equities is always in cash and not physical. However, when it comes to commodities, the settlement is physical and therefore delivery is compulsorily. This means if you hold 10 lots of silver and you opt for delivery, then you will get delivery on 300 kg of silver. In order to get the delivery of the commodity, one has to express his intention to do so. This has to be done any time before 4 days to expiry. So given that the expiry is on 5th, one has to express his intent to take delivery any time on or before the 4th, 1st, 2nd, 3rd, 4th. If you are trading with zero to, note that we do not allow you to get into the physical delivery of commodities. So you will be forced to close the position before 1st of the expiry month. In fact, I personally prefer to close the positions early on and not really get into the physical delivery of commodities just because of the logistics involved. Another important point to note here, while the delivery is mandatory for silver 30 kgs contract, delivery is not mandatory for the silver mini and silver micro contracts. This means to say that you can let the silver mini micro contract expire and settle for cash or opt for delivery. However, you do not have the option to cash settle the silver 30 kilograms contract. Finally, here is something else you should know. Have a look at this snapshot below. The table above maps a commodity with a location. For example, silver micro is mapped to Ahmedabad. Ever wondered what this really means? We all know that upon expiry, the price of the underlying in the spot market and its futures price converge to a single price point. Now in case of equities, the underlying and its futures are traded on the same platform, i.e. NSE and now BSE as well. So for example, Infosys spot and NSE will converge with Infosys futures on NSE. However, in case of commodities, there are many different spot markets. For example, pepper and rubber are prominently traded in Kochi. Gold is traded in both Mumbai and Ahmedabad and so on. Given this, upon expiry, the futures of gold should merge with which spot price? Should it be the one in Mumbai or the one in Ahmedabad? For this exact reason, MCX has mapped each commodity with a spot market. And upon expiry, the futures price will converge with the price of the designated spot market. 9.4 The other silver contracts. If you are comfortable with the contract details of silver mentioned above, then it is fairly easy to understand the other silver contracts that are traded on MCX. They vary mainly in terms of the lot size and therefore the margin requirement. I'll skip working out the math, but instead put up the margin numbers and the delivery option directly for you. The delivery option helps you decide whether you would like to take delivery of the contract or simply cash settle. Contract margin, required margin as a percent, delivery options. Silver Mini 13,158 rupees per 6.27% cash physical. Silver Micro 2,618 rupees per 5.1% cash physical. Silver 2,711 rupees per 6.2% physical only. As you can see, the margins required are much lesser, quite naturally, compared to the big silver contract. As far as trading is concerned, similar to gold, the silver fundamentals are quite complex. Tracking them on a day-to-day basis may not really be possible, and in fact is not really required. Most traders I know trade commodities based on technical analysis. I personally think this a much better way to go about active commodity trading. Apart from technical analysis, one can even choose to trade based on quantitative techniques such as pair trading. As stated earlier in this chapter, we'll discuss this technique in a separate module altogether. Key takeaways from this chapter. Gold and silver are correlated both on an intraday basis and on an end-of-day basis. Gold and silver make a good pair for trading based on the pair trading technique. Silver does not have a great correlation with crude oil. There are 4 variants of silver traded on MCX. The main silver contract has a lot size of 30 kgs and requires a margin close to 75,000 rupees per. The average margin requirement for silver is roughly between 5 to 6% of the contract value. Technical analysis works quite well on silver. 10 responses to silver. Open a ZERODHA account. Chapter 10. Crude Oil, Part 1. Digging the Past. 10.1 The Commodities Superstar. If I have to pick one international commodity which can give you all the dramatic ups and downs of stock markets as portrayed in the movies, then it has to be the crude oil. Wonder why? Have a look at the chart below. The dramatic rise to $140 per barrel to the immediate sharp correction. Then a recovery back to near $110 to a merciless crash to sub $30. The crude oil chart can invoke all human emotions, just like a perfectly well-directed movie. The fact that this is an international commodity, actively traded by hundreds of thousands of traders across the globe, only adds to the complexity of it all. So what is really going on in crude? Why did crude crack from the highs of $115 all the way down to $28? What caused this manic panic? What is happening to crude now? Where are we headed now? To understand this fully, we need to rewind and dig into the recent history of 2014-15. This is exactly what we will do in this chapter. For the sake of this chapter, let us go back to first half of 2015 and see how things looked back then. 10.2 The Crisis Revisited. From over $110 per barrel in January 2014 to a low of $28 per barrel in January 2016. The Brent crude oil has perhaps seen the worst decline in prices over the recent 5 years. While this dramatic price decline has brought cheer to a few corporate and perhaps few countries, it has disrupted oil-producing economies. Literally nobody saw this coming, even if someone did. The magnitude of this fall, over 75%, was beyond everybody's wildest imagination. Is this the bottom of the crash? Well, your guess is as good as mine. But the intensity of the crash in crude oil is so severe, it would be hard to believe the bottom is in sight. So what really went wrong? To understand what went wrong, we need to understand the dynamics of crude oil and how business was carried out before the recent crash. This discussion also doubles up as oil basics for you. Oil-rich countries produced several million barrels of crude oil which were exported to the US, China, India, and European countries on a daily basis. The oil-producing countries are split into 2 baskets. Organization of the Petroleum Countries, OPEC nations, which include countries like Saudi Arabia, Qatar, Kuwait, UAE, etc., and other oil-producing countries such as Brazil, Canada, Russia, Mexico, Norway, etc. choose not be part of the oil cartel, i.e., OPEC. Hence they are just referred to as non-OPEC countries. Between the OPEC and non-OPEC countries, close to 90 million barrels of oil were pumped on a daily basis. The graph below shows the daily oil production split between OPEC and non-OPEC countries. The trigger. Different countries produce oil at different rates. This rate at which they produce mainly depends on the individual country's finances and technology, while production depends on internal factors. The sale of oil has always been driven by markets. Clearly, the break-even point, expressed on a per-barrel basis, is the rate at which countries need to sell per barrel of oil to cover the expense of producing the same. Varies from country to country. Naturally, selling oil below the break-even point implies that the country cannot balance their state budget. The table below shows the break-even points for the OPEC countries. Country break-even point on a per-barrel basis asterisk. Iran $130.70. Algeria $130.50. Nigeria $122.50. Venezuela $117.50. Saudi Arabia $106. Iraq $100.60. UAE $77.30. Qatar $60. Kuwait $54. In the backdrop of these trade dynamics, a triple-digit oil price till early 2013 worked really well for the oil-producing economies. However, the recent developments changed the landscape of crude oil business dynamics. Specifically, the following three major events turned the tables around for crude oil prices. American shale oil. The American shale oil, which comes from oil shale, sedimentary rocks containing bituminous material, which is an alternate to crude oil, became technologically viable and the cost of producing the same became relatively cheaper. The output from the American shale oil production increased, flooding the market with cheaper oil. By current estimates, it is believed that U.S. has enough shale oil reserves to last generations. Shale oil from Texas and North Dakota displaced exports from OPEC members to the USA. This set the stage for a collapse in crude oil prices. Lack of coordinate action. In the backdrop of increased shale oil production in the USA and the ongoing slide in crude oil price, one of the methods for oil-producing countries to control the situation was to lower the supplies and regulate the demand-supply situation. However, OPEC was not really successful in convincing OPEC and other non-OPEC oil-producing countries to cut the crude oil production to support the crude price. In fact, cutting oil production is considered more expensive than pumping oil. China factor. China has been one of the largest consumers of major international commodities, including iron ore, coal, and crude oil. In fact, in 2013, China surpassed the U.S. in oil imports. However, reports suggest that the Chinese economy is not growing at the same pace as it used to, resulting in lower demand for international commodities. Needless to say, this has a significant impact on the spiraling crude oil prices. Market dynamics. The above 3 points triggered a steep sell-off in crude oil. Adding fire to this sell-off was the heavy short positions built up on crude oil contracts. Generally, when the price of crude oil falls, the US dollar tends to get stronger, especially over the currencies of the emerging economies. This is quite natural as an increase in oil price widens the U.S. current account deficit. Remember, U.S. also imports oil from the Middle East, which obviously is not a great factor for the U.S. dollar, and the reverse helps the dollar strengthen. Hence the dollar and oil share an inverse relation. Do recollect, in 2008 when oil hit a peak of $148, U.S. dollar was trading at 1.6 to the euro. The Russian episode. Russia is one of the largest non-OPEC producers and exporters of oil. The Russian Federation's oil exports contribute nearly 40% of the total exports. With a slump in oil prices, the Russian economy seems considerably weakened. There are three factors working against Russia, two of which can be directly attributed to the oil prices. Oil price. Russia needs the oil prices to be approximately in the region of $105–107 to balance its budget and keep its finances in order. Clearly, with oil at $50, Russia gets a severe blow on its budget. Ruble trouble. Remember, Russia is an emerging economy. With the slide in oil price, the Russian ruble has massively weakened against the US dollar. So much so that the Russian central bank increased the interest rate overnight by 7.5% in order to defend the ruble. Yes, this did happen back in 2015. Crimea curse. Western countries continue to impose sanction cuts on Russia for its aggression on Ukraine. This means access to external capital is extremely difficult, especially when it's most required for Russia. Add to this the Syrian crisis and a host of other local factors. There is little hope that Russia may not actually slip into a financial coma, dragging the Federation into a recession. The India macro angle. On the face of it, the fall in crude oil seems to significantly benefit India as the pressure on petroleum subsidy eases. India, being a net oil importer, nearly two-thirds of India's oil is imported, pays a heavy bill for its oil imports. Naturally, the fall in crude oil means improvement in the fiscal deficit, easing of inflation, and possibility of an interest rate cut, all of which is desirable for India in the backdrop of the current economic situation. But there is another angle to low oil prices. While low oil prices help the domestic import bill, it will also impact our exports receipts. Most of the exports from India are to countries whose economy depends on oil: UAE, US, Saudi Arabia, Kuwait, Iran, China, etc. Quite naturally, with low oil prices, the spending by these countries also decreases, thereby impacting business with India. In fact, if you go back and look at the October 2014 import and export data from RBI, it clearly suggests the same. While the oil import bill reduced by 19% YOY, the exports also declined by 5%. Clearly, the advantage of low oil prices, not the boon it seems to be. In fact, on the 6th of January 2015, we got a glimpse into what can happen if the oil price continues its fall. The NSE Nifty fell over 255, approximately 3.0% decline points, creating a ruckus on the street. Impact on the Indian companies. State-owned oil marketing companies, OMC, such as HPCL, BPCL, and IOC are a direct beneficiary of low oil prices. Low oil price has a positive impact on oil marketing companies, OMC, in terms of reducing the stress on their working capital requirements. In fact, both BPCL and HPCL have retired over 50% and 30% of their short-term borrowings over the last 2 years respectively. If the price of crude oil prices stabilizes around the current level of $50 per barrel, then naturally it will be great for these companies in terms of cleaning up their balance sheets and improving their bottom line. Is this the end? Well, this just depends on the supply-demand situation. Clearly, as Saudi Prince Al-Walid bin Talal says, if the supply stays where it is and the demand continues to be where it is, then there is little hope for the oil prices to bottom out here. Besides, the US has withdrawn the 40-year ban on export of oil, which means more supply to the market, thereby putting more pressure on prices. Last month, i.e., September 2016, OPEC has finally agreed to cut the production in order to support the oil price. You can read the article on Bloomberg. American shale oil has no doubt created a ripple in the market, but there is another angle to this. How strong are the balance sheet of these companies fracking shale oil? Are they over-leveraged? Are they overstating the reserves? These are things the market will learn sooner or later, which will again impact crude oil prices. However, at this stage, if you ask me, is this the bottom of the oil price crash? Well, your guess is as good as mine. Please note, unlike all the previous chapters on Varsity, this chapter will not have any key takeaway points, as I've just narrated what really happened to crude. What we have discussed today could just be a piece of irrelevant history going forward. P.S. I have taken all the inputs for this chapter form. The special report on oil crisis was published by Dalal Street Investment Journal. Authored by me. 46 responses to crude oil, Part 1.